Look, I need to show you something that's happening right now in the precious metals market. And I'm not talking about price predictions or technical analysis. I'm talking about physical metal disappearing from dealer inventories at a pace I've never seen in my career. 3 days ago, I got a call from a dealer I've worked with for 15 years. He told me something that made my blood run cold. "We're out," he said. "Silver Eagles, Maples, Buffaloes, gone, and we can't get more until next week at the earliest." This isn't one dealer having a bad week. This is happening across the industry. Let me paint you a picture of what's actually going on behind the scenes. Right now, refineries are running at maximum capacity. They're working overtime, weekends, holidays, and they still can't keep up with demand. The backlog for refined silver products has stretched from the usual 2 weeks to 6 weeks in some cases. 6 weeks. Think about what that means. Here's where it gets interesting. The silver market operates on something called lease rates. These are the rates at which bullion banks lend silver to industrial users and other market participants. In a normal market, these rates hover around 1 to 2%. Right now, they've spiked to levels we haven't seen since the financial crisis. We're talking 8, 9, even 10% in some cases. Why does this matter? Because high lease rates tell you something critical about the physical market. They tell you that people who have silver don't want to lend it out. They're holding on to it. And people who need silver are willing to pay premium rates to get their hands on it. This is the market screaming at you that physical metal is tight. But here's what most people don't understand. The silver market isn't just about investment demand. Industrial demand accounts for more than half of all silver consumption, and that demand is exploding. Solar panels alone are projected to consume over 200 million ounces this year. Electric vehicles use twice as much silver as traditional cars. 5G infrastructure, medical devices, water purification systems, the list goes on. Now let me tell you a story about what happened in the early 80s. Silver hit $50 an ounce. The Hunt brothers tried to corner the market. Everyone remembers that part. But what most people forget is what happened before the price spike. For months, industrial users were scrambling to secure supply. Refineries couldn't keep up. Sound familiar? The difference this time is that we don't have a couple of billionaires trying to manipulate the market. We have structural supply deficits. Silver mine production has been declining for years. The easy deposits have been mined out. New discoveries are rare. And here's the kicker. Most silver comes as a byproduct of copper, lead, and zinc mining. When those metals aren't profitable to mine, silver production drops too. Let me show you what's happening with the numbers. The Silver Institute reports that we've been running supply deficits for 4 consecutive years. That means demand has exceeded new supply by hundreds of millions of ounces. Where's that silver coming from? Above ground inventories, stockpiles, and those stockpiles are getting drawn down. COMEX inventories tell a fascinating story. These are the registered inventories available for delivery against futures contracts. Over the past year, they've dropped by 30%. 30%. And it's not just COMEX. The London Bullion Market Association vaults have seen similar drawdowns. This is physical metal leaving the system. Now, here's where the dealer situation comes in. Dealers operate on thin margins. They need to turn inventory quickly. When they sell an ounce of silver, they immediately order a replacement from their suppliers. But right now, their suppliers are telling them the same thing. We can't get it fast enough. The refineries are backed up. The mints are backed up. The whole supply chain is stretched to the breaking point. I talked to another dealer yesterday. He told me he's got customers calling every day asking when he'll have product back in stock. Some of these customers are willing to pay premiums of $5, $6, $7 over spot price. That's unheard of in normal markets. The typical premium on a Silver Eagle is maybe $3. When you're seeing premiums double, that's telling you something about the physical market that the paper price isn't reflecting. And that brings me to something crucial you need to understand. There are 2 silver markets. There's the paper market, where futures contracts and derivatives trade on exchanges. And there's the physical market, where actual metal changes hands. These 2 markets are supposed to track each other closely, but right now they're diverging. The paper price is what you see quoted on financial websites. It's determined by trading on the COMEX and other exchanges. But the physical market is showing much higher prices through these premiums. When you go to buy actual silver, you're paying significantly more than the spot price suggests you should. This divergence is a warning sign. Let me tell you what happened in 2011. Silver ran from $30 to nearly $50 in a matter of weeks. Before that run, we saw the same pattern. Physical premiums expanding, dealer inventories tightening, lease rates spiking. The paper market was slow to react, but the physical market was screaming that something big was coming. Here's what's different this time. In 2011, we didn't have the industrial demand we have now. Solar was a fraction of what it is today. Electric vehicles were barely on the road. 5G didn't exist. The industrial demand picture has fundamentally changed, and industrial users can't wait for lower prices. They need the metal to keep their production lines running. Think about a solar panel manufacturer. They've got orders to fill. They've got contracts to honor. If they can't get silver, they can't make panels. So they pay whatever it takes to secure supply. They're not speculating on price. They're buying because they have to. And that kind of demand is incredibly price inelastic. Now, let's talk about what central banks are doing. While everyone's focused on gold, something interesting is happening with silver. Countries are starting to recognize silver's strategic importance. It's not just a monetary metal anymore, it's a critical industrial metal. And in a world where supply chains are being weaponized, controlling access to critical materials matters. China has been particularly aggressive. They've been building strategic reserves of industrial metals for years. Silver is on that list. They're not buying it to speculate. They're buying it because they understand that whoever controls the supply of critical materials has leverage in the new global economy. Quick aside here. If you're sitting on retirement accounts worth $100,000 or more, you might want to look into how gold IRAs work. I put together a free guide that covers how to get physical precious metals into your retirement account without triggering tax penalties. It's in the description. Worth checking out if wealth preservation is on your mind. But let me get back to what's happening with supply. The refinery bottleneck is more serious than most people realize. Refineries don't just appear overnight. They require massive capital investment, environmental permits, skilled workers. And right now there's no incentive to build new capacity because the paper price doesn't reflect the physical shortage. Refineries make money on volume, not price. If they can't be sure demand will stay high, they won't invest in expansion. This creates a vicious cycle. Tight supply drives up physical premiums. But the paper price stays relatively stable because futures traders are looking at different signals, so refineries don't see the price signal they need to justify expansion. Meanwhile, the physical shortage gets worse. Let me tell you about a conversation I had with a refinery operator. He told me they're getting calls from dealers offering to pay premium prices for faster delivery, but they can't speed up the process. Refining silver takes time. You can't rush chemistry, and they're already running flat out. Here's what happens next. As dealer inventories stay depleted, more buyers are going to start placing orders directly with refineries. But refineries have minimum order sizes. Small buyers get pushed to the back of the line. This means the physical market becomes increasingly inaccessible to retail investors. The metal flows to whoever can place the biggest orders and wait the longest. Now think about what this means for price discovery. If the physical market becomes disconnected from the paper market, where's the real price? Is it the spot price on COMEX? Or is it the spot price plus the premium you actually have to pay to get metal in your hand? This is a question the market is going to have to answer. I want to show you something else that's happening. Exchange-traded funds that hold physical silver are seeing interesting flows. Some days they're seeing inflows as investors buy shares. Other days they're seeing outflows as large holders redeem shares for physical metal. This redemption process is another drain on available supply. When someone redeems ETF shares for physical, that metal leaves the vault and enters private hands. The LBMA, the London Bullion Market Association, is the center of the global physical precious metals market. Their vaults hold silver for banks, ETFs, and large institutional investors. The amount of silver in LBMA vaults has been declining, not dramatically but steadily. And here's the thing about LBMA silver. It's not all available for sale. Much of it is already owned. It's just being stored there. So when you hear about LBMA inventories, you need to understand that only a fraction of that metal is actually available to meet new demand. The rest is locked up in long-term holdings. This makes the available supply even tighter than the headline numbers suggest. Let me paint you a scenario. Imagine you're a pension fund manager. You've been reading about inflation. You've been watching the dollar weaken. You decide you want to add some precious metals exposure to your portfolio. You call your broker. You want to buy $10 million worth of physical silver. Your broker calls their contacts, and they tell you, we can get you the metal, but it's going to take 6 weeks, and you're going to pay a significant premium over spot. What do? You can buy paper silver through futures or ETFs, but you wanted physical. You wanted the security of knowing the metal exists and you can take delivery if needed. So you wait. You pay the premium. And that $10 million of buying pressure just hit a market that's already tight. Now multiply that scenario by all the institutional investors who are starting to think the same way. Multiply it by all the industrial users who need to secure supply. Multiply it by all the retail investors who are watching premiums expand and realizing they better buy now before it gets worse. That's the demand picture. On the supply side, you've got mines that take years to develop. You've got refineries running at capacity. You've got mints that can only produce so many coins per day. You've got a supply chain that's stretched thin. And you've got no quick way to increase supply in response to rising demand. This is what economists call inelastic supply. When demand goes up, supply can't quickly respond. And that's when you get price spikes, not gradual increases. Spikes. Because the market has to ration limited supply, and the only way to do that is through price. Let me tell you what happened in 2008 during the financial crisis. Silver dropped to $9 an ounce. Everyone thought the world was ending. But something interesting happened. Physical premiums exploded. You couldn't buy Silver Eagles for anywhere near spot price. Dealers were charging $5, $6, $7 premiums on a $9 spot price. The physical market was saying, "We don't care what the paper price is. This is what real metal costs." Fast forward to today. We're not in a financial crisis. The economy is still growing. Industrial demand is strong. And we're already seeing premiums expand. What happens if we do hit economic turbulence? What happens if investors start rushing into precious metals as a safe haven? The physical market is already tight. Add a surge of investment demand on top of strong industrial demand, and you've got a recipe for a serious supply crunch. Here's something most people don't think about. Silver is used in tiny amounts in most applications. A solar panel might contain a fraction of an ounce. A smartphone contains even less. But when you're producing millions of units, those tiny amounts add up. And because silver is such a small part of the total cost of these products, manufacturers will pay up for supply rather than shut down production. Think about it. If you're making a $1,000 smartphone and the silver content is $2, you'll pay $4 for that silver before you'll stop production. The silver cost is negligible compared to the value of the finished product. This is why industrial demand is so price inelastic, and it's why industrial users will outbid investors when supply gets tight. Now let's talk about what's happening in the mining sector. Silver miners are in a tough spot. The price of silver hasn't kept pace with the rising costs of mining. Energy costs are up. Labor costs are up. Equipment costs are up. Environmental compliance costs are up. And the easy deposits are gone. New mines are deeper, lower grade, more expensive to operate. What does this mean? It means that even at current prices, many potential silver projects aren't economical. They don't generate enough return to justify the capital investment and risk. So they don't get developed, and that means future supply growth is constrained. There's another factor at play. Most silver comes as a byproduct of other metals. Only about 30% of silver production comes from primary silver mines. The rest comes from copper, lead, zinc, and gold mines. So silver supply is tied to the economics of those other metals. If copper prices are low, copper mines cut production, and silver supply drops as a side effect. Right now, we're in a situation where multiple factors are constraining supply while multiple factors are driving demand. That's the setup for a supply squeeze. And that's what we're seeing play out in real time with dealer inventories. Let me tell you about the COMEX delivery process because it's relevant to understanding the current situation. When someone wants to take physical delivery of silver from COMEX, they have to go through a specific process. They need to have an account with a clearing member. They need to post margin. They need to arrange for storage or transportation. It's not simple. It's not quick. And most futures traders never intend to take delivery. They're just trading the price. But lately, we've been seeing more delivery notices. More people are standing for delivery instead of rolling their contracts forward or closing them out. This is another sign that the physical market is tight. People want the metal, not just exposure to the price. When delivery notices increase, it puts pressure on the shorts. The people who sold those futures contracts now have to deliver metal. They have to go into the physical market and buy. And if the physical market is already tight, that buying pressure makes it tighter. Here's where it gets really interesting. There's a concept in the futures market called the basis. It's the difference between the futures price and the spot price. In a normal market, the futures price is slightly higher than spot because of carrying costs. But when the physical market is tight, the basis can go negative. the spot price can actually be higher than the futures price. This is called backwardation, and it's a sign of physical shortage. We've been seeing intermittent backwardation in silver, not consistently, but it's been showing up. And each time it appears, it's telling you the same thing. The physical market is tighter than the paper market reflects. Now, think about what happens when dealers run out of inventory. Buyers don't just give up. They go looking for other sources. They call other dealers. They check online retailers. They look at auction sites. And what they find is that everyone is in the same boat. Inventory is tight everywhere. This is when premiums really start to climb, because sellers realize they have pricing power. If you're one of the few dealers with inventory, you can charge more, and buyers will pay it because they don't have alternatives. This is basic supply and demand, but it plays out in real time in the precious metals market in a way that's visible and measurable. Let me tell you about a pattern I've noticed over the years. Every time we see a supply squeeze building, there's a period where most people don't notice. Premiums start creeping up, delivery times start stretching out, but the spot price stays relatively stable. This is the early warning phase. The physical market is sending signals, but the paper market hasn't caught on yet. Then something happens. Maybe it's a news event. Maybe it's a large buyer entering the market. Maybe it's just the cumulative effect of the supply deficit. But suddenly the paper market wakes up. Traders realize the physical market is tight, and the spot price starts to move. Once that happens, the squeeze accelerates because now you've got momentum traders and technical traders piling in on top of the physical demand. We're in that early warning phase right now. The physical market is sending clear signals. Dealer inventories are depleted, premiums are expanding, lease rates are elevated, refinery backlogs are growing. But the spot price hasn't made a major move yet. This is the window. This is when the smart money positions itself before the crowd figures it out. Here's what I want you to understand. This isn't about predicting the future. This is about reading the present. The supply situation is what it is. The demand situation is what it is. The refinery capacity is what it is. These are facts, not forecasts. And those facts are telling you that the physical silver market is under stress. What happens next depends on how demand evolves. If industrial demand stays strong and investment demand picks up, the squeeze intensifies. If a major buyer enters the market, the squeeze intensifies. If geopolitical tensions drive safe haven demand, the squeeze intensifies. There are multiple paths to the same outcome. And here's the thing about supply squeezes. They don't resolve quickly. You can't just turn on a switch and produce more silver. Mines take years to develop. Refineries take time to expand. The supply response is slow. So once a squeeze starts, it tends to persist until demand destruction occurs. And demand destruction in silver requires significant price increases because of how price inelastic industrial demand is. Let me give you a historical parallel. In the late 70s, we had a similar setup. Industrial demand was growing. Mine supply was constrained. Investment demand was picking up because of inflation concerns. The result was a price move from $5 to $50 in less than 2 years. Now, I'm not predicting that kind of move, but I am saying the fundamental setup has similarities. The difference today is that industrial demand is even more critical. In the 70s, silver was used in photography, electronics, and some industrial applications. Today, it's essential for the energy transition, for telecommunications infrastructure, for medical technology, for water purification. The industrial demand base is broader and more critical than it's ever been. Think about what happens if we're serious about transitioning to renewable energy. Every solar panel requires silver. Every electric vehicle requires silver. Every charging station requires silver. The amount of silver needed for the energy transition is measured in billions of ounces, and we're running supply deficits of a couple 100 million ounces per year. The math doesn't work unless either prices rise significantly to incentivize new supply, or the energy transition slows down. Here's another angle to consider. Silver has always been money. For thousands of years, silver was the primary medium of exchange for ordinary people. Gold was for large transactions and wealth storage. Silver was for everyday commerce. That monetary history doesn't just disappear. It's embedded in human psychology and culture. When people lose faith in paper currencies, they turn to precious metals. And while gold gets most of the attention, silver is more accessible. You can buy an ounce of silver for $30. An ounce of gold costs over $2,000. For most people, silver is the entry point into precious metals. And if we see a wave of currency concerns, silver demand could explode. Now I want to bring this back to the immediate situation. Dealers are telling you they're out of stock. Refineries are telling you they're backed up. The physical market is telling you supply is tight. This isn't speculation. This isn't theory. This is what's happening right now. The question you have to ask yourself is, what am I going to do with this information? Are you going to wait and see what happens? Are you going to assume the situation will resolve itself? Or are you going to recognize that when the physical market is sending this many signals, it's probably smart to pay attention? I can't tell you what to do, but I can tell you what the market is telling us. And right now, the market is saying that physical silver is becoming increasingly difficult to obtain at anywhere near the paper price. The divergence between paper and physical is widening, and historically, when that divergence gets wide enough, something has to give. Either the paper price rises to reflect physical reality, or the physical market becomes completely disconnected from the paper market. Neither outcome is good for people who wait. In the first scenario, you're buying at higher prices. In the second scenario, you might not be able to buy at all, at least not without paying massive premiums. Here's the bottom line. The metal supply situation is serious. It's not hype. It's not fear-mongering. It's what dealers, refineries, and market participants are experiencing in real time. The supply chain is stretched, inventories are depleted, demand is strong, and the ability to quickly increase supply is limited. This is the kind of situation that, when you look back on it, you'll either be glad you acted or wish you had. The signals are there. The data is there. The question is whether you're going to recognize what it's telling you before everyone else figures it out. Because once the crowd catches on, the opportunity to position yourself ahead of the move is gone.